Hello and welcome to the stock specific class here for Thursday, June the 8th. If you have any questions, make sure you send those to Jerry at TradersPro.com. As far as market conditions, obviously we had a little bit of a sell-off yesterday, although it was a mixed market move again. And what it really signaled was a kind of a rotation. So although we have started to see the mega cap tech stocks break down a little bit. What's probably happening right now is that money is coming out of profit taking is coming out of those stocks, and since we saw the small caps rally the last couple of days, it looks like money is coming out of the big cap tech and into some of the small caps. Now that's typically a little bit more of a bullish type of behavior. When it's bearish is when all the indexes are selling off and money is going to the sidelines. So, but it also is important because the moves on some of those mega cap tech stocks were pretty big, 4 or 5% drops yesterday. And typically at a top like that, when they've gone kind of parabolic, that's usually a sign that there's a bigger pullback coming. So I'm not suggesting they're going to fall apart and come all the way back down. That would take probably a market panic of some sort to do that. But I can see where they're maybe starting a correction, and maybe a little bit of a deeper correction that could be taking place. So we'll continue to keep an eye on that. But again, that's why we wanted to focus on that. Remember last class we were looking at those mega cap tech stocks, and we were saying that they were starting to show buying exhaustion. You know, we started to see some of those indecision candles and some of those shooting star bearish candles, but they weren't actually rolling over yet. And I think yesterday we saw that. And usually, again, you get a 4-5% move off of the top. That's usually the start of a pullback, as opposed to the continuation of an uptrend. So we'll continue to watch that. But as far as the direction alerts here, we're still having a problem a little bit with breadth momentum. Although it backed off a little bit with the recent selling, it would push right back to that far right side with any sort of a continued market rally. We're bumping up on the S&P, as we'll look at the chart here in a second, against a critical resistance area. It's an area where if we break above it significantly, we'll have to start taking more of a bullish outlook, just because of the probability shifts at that point. I'll talk about that here in a second. I might have touched on it on Tuesday, but I'll talk about it again here today. But the point here is that where everything is at right now. You look at the momentum indicator, you look at the VIX, you look at the chart where the resistance is. It's just hard to picture the market rallying significantly from here without having some sort of a decent pullback. And it might just be a pullback, 3 or 4 day pullback, 2 or 3 day pullback like we saw last month. We saw a couple of them last month, and I'll point those out when we look at the chart. It might be just something like that. But with the way the VIX is behaving, like I said, in the move it made today again, I mean, have you ever stretched a rubber band to the point where it's about to break, and it's stretched pretty far, and you push it and you stretch it even some more, and at any moment that thing is going to snap and probably hurt your fingers, but you just keep stretching it, and that's what it feels like. It just feels like it's just getting ready to snap, and we're at the breaking point, but it hasn't snapped yet. But that's really what every day it starts to feel like that. And again, I don't know. Again, it might be one of those things where, well, I hope it's one of those things that we're sitting back in hindsight saying that the warning signs were there, because I'd hate for the market to totally shake off something like this and then just charge forward. Where I'd have no faith in reading the VIX anymore at that point, because it definitely is warning. It's like the alarm bells are going off and the market is not even paying attention to it, at least. And there's a lot of traders that aren't paying attention to it either. So we'll see. I've gotten to the point where I don't look at anything as absolute or guaranteed, or it's just, you just can't get me to say it's going to happen anymore, because the low probability moves have taken place from time to time. All right, so momentum and then breadth obviously is lagging. Now, the breadth did pick up a little bit, and you would expect that to. We've been talking about the mega cap tech stocks being what's holding the market up, and that is true. That has been the case. But over the last few days, with that sharp rally in the Russell 2000, it tells you that's broadening out a little bit. Now, I don't know if that's going to continue. I've talked about this before, where there's two ways to look at when you have a narrow breadth like that. There's two ways to look at it. There's either you're expecting eventually the rest of the stocks to start participating and to catch up to those mega cap tech stocks, the run that they've been on, or you're looking at it rolling over and the mega cap tech stocks coming back down to where the small caps are. So again, obviously one would be a bullish outlook, one would be a bearish outlook. Again, from a probability standpoint, typically the small caps are leading the way and are pulling the large caps along in a healthy uptrend, because it's a broad participation at that point. Usually it's not the other way around, and so that's why I'm leaning more towards the market selling off and those big cap tech stocks coming back down towards the Russell. But like I said, we're going to point out a couple areas here that we're going to keep an eye on, that if we start, we're either going to break above there and turn more bullish, or we're going to, we're in an area here where that bigger sell-off could start to take place. Now, keep in mind that, and I've had this on my calendar. I usually don't even talk about it, and I definitely don't have it on a calendar. But because the market has been so focused on it, I've gone out and put down when the CPI report or when the Fed meetings are happening, and that's all next week. We get CPI on Tuesday, PPI, and the Fed meeting on Wednesday. PPI will come out before the market opens on Wednesday, and then the Fed meeting is right around when we start class. The announcement will be made there. Now, I don't know what the outcome of that is. I really don't care. I'm leaning more towards where we're at right now to be a little bit more of a negative outlook, especially since a couple of the last meetings there's been a little bit more of a bullish outlook. I think especially if the Fed does hike again, which they definitely could with the jobs report being as strong as it was last Friday, remember the market has been, the rally in the market has been based off the expectation that the Fed's actually going to start lowering rates by the end of the year. I mean, we're in the summer now, and if they're still hiking, they haven't even started pausing yet, then I think that takes off. Remember, the market's already priced that in, rate cuts by the end of the year. I think it's gonna have to correct that. It's gonna, the outlook is gonna have to push it into next year, and they're, again, all those people that do all those calculations will have to try to figure out when next year they think it'll start to happen. But in the meantime, the market would probably sell off to kind of take back what it already priced in. But again, like I said, I was pretty convinced the jobs report would, and again, it was a good number, but that was the problem, is that the Fed needs to see a higher unemployment before they're going to stop cutting. And we say don't fight the Fed, and that's what they've been telling us. That's what they say they're going to do, and so it was kind of shocking that the market rallied like it did off of that. But there again, that's why I don't get too focused on what I think is going to happen, because the market will always do things that don't make sense, and you just have to make sure you're still focused on what it is actually doing. What is the trend? What is it doing? So that you don't you don't develop too strong of a bias to be on the wrong, to ignore what is actually taking place. Okay. And that's what we're trying to do here in class when we look at the charts here. I'm going to show you where do we need to turn more bullish, where can we maybe turn a lot more bearish. We'll take a look at that there on the chart. Now, the buy-sell ratios, not stretched by any means. We are seeing the buys outpace the sells, and again, a lot of that is because of that small cap participation, more stocks participating in the rally. And this is a reflection of that. We had the market going higher, but we weren't seeing buys outpace the sells. We just now started to see that. Why? Well, because the small caps were rallying. This was also a reflection of that rally was narrow. When the market's rallying, you should see the buys outpace the sells. We weren't seeing that until now, just over the last few days. And yes, I don't think it's a coincidence when you look at that chart of the Russell 2000. You see the big move that made it over the last couple of days. But it's not stretched, and that's what we look for here. So that's not showing extreme. Again, the market momentum was showing extreme. This sentiment indicator here is showing extreme. Now it's back below the red line. Hold on. Excuse me. It's back below the red line up here. But remember, this updates overnight. If the market is rallying a little bit today, it wouldn't take much to push it right back above it again. So again, it's hard to picture the market rallying significantly when these indicators in these areas, when almost every time you hit this, you get a little bit of a market sell-off. Now, it's not always a major sell-off, that you get some sort of a market pullback out of this range. And here we've gone to extreme overbought. And I hope you're using these tools, because that's helpful to kind of make decisions. It doesn't mean that the sell-off has to happen immediately, or sometimes it can lag a little bit, but it tells you where you are in the cycle. And right now you're at a top, a near-term top, and it can stay overbought for a little while. But that's the question. Do you want to risk grabbing that extra dollar for the risk of a $4 loss? Because the markets fall a lot faster than they rise. And let me show you an example of, let's show you just a quick example of Amazon. So Amazon showed a bearish reversal right here. All right, so do you risk making that extra couple dollars of it going higher, which it did end up going higher, with the risk of a $4 drop immediately, before you can do anything? Yesterday wiped out the previous 4 days in one day. And this is kind of what we're talking about here. Say we're getting these warning signs. Do you still want to get greedy? Are you so greedy where you're trying to grab more and trying to get that extra crumb? And what ends up happening, it wipes out the last week of all your energy in those trades. Now, sometimes it can wipe out the whole month in some of these moves immediately before you can do anything. And so that's why we're paying attention to these. We're not saying that they're telling us that it's going to drop tomorrow or immediately. What we're saying is we're in a position where we could get those big drops that wipe out, days or weeks of work or energy. Okay. And usually it's not worth trying to grab that extra dollar and then end up losing 5 or 6 or something in the process. So this is helpful in making decisions. What decisions do you make? Well, you either, build more of a cash position, tighten up stops, You could buy put options to protect your stock positions. That's what I would do I'd buy put options to protect stock positions. As far as actually buying puts, you'd have to be a little bit more specific to the stock. Are there already stocks that are showing bearish reversal patterns? And yeah, you can buy some put options on some of those where you're not protecting a stock position, but you're speculating on a drop. But that's the type of condition you're in. You wouldn't want to be buying a ton or betting on a big upside move. You can still get small upside moves, and I'm going to show you here that the S&P might have one more push higher. But that's why we go through these, is to recognize, are we stretched one way or the other? Now, if you've been in these classes a while, you know that sometimes we just blow through these direction alerts because none of them are showing us or in any sort of extreme condition. What they tell us is that we could go either way in a big move, and that without being stretched. But now we're definitely showing signs of overbought, stretched quite a bit to the upside, and that shows up on the VIX, which we'll look at here in a second as well. It shows up amazingly on the VIX that something big is about to happen, but we'll see. We'll look at that here in a second. All right, let's take a look at the charts. Let's start with the S&P. It's moved. So this is what's been happening a lot lately, is you get the big move, you get the report, the big move happens, and then it dies. And we had the jobs report. This is Friday right here. And then we have not traded above that high or closed above that high since it happened. Okay. Now, the fact that we are moving sideways, you hear me say this all the time, whenever you see a stock moving sideways, you want to pay attention to the direction it was moving in before it moved sideways. That's where it's more likely to go after it's done moving sideways. So the way it's behaving right now would lead to a stronger probability that it goes higher, although it doesn't have to go much higher. I mean, all that phrase means is it should continue in that direction. So if it had a move where it just broke out above that range, that'd be enough to satisfy that phrase or that rule of thumb, so to speak. Okay. But this behavior it's not dropping, but it's not running up, but it's not dropping either. So the sellers aren't gaining any ground here yet. Now, when you back out, you can see the critical area that we're focused on, which is this August high from last year. And we're just below it. So what I'm anticipating is that we might push into it. What I actually would love to see would be a gap up reversal, that creates those black candles on my other charting service. A gap up tomorrow, and then it sells off. Gaps up to this area and then sells off. That would be a strong signal that a downward move is about to begin. But the reason why this area is so critical is not only is it one of these previous highs, but we were focused on this previous high as well, and it broke above that. But this one is right at the 618 retracement of this entire move down. And my retracement tool on my other charting service is a little bit easier to use, so I'm going to use it on that. Sorry, I keep apologizing, but it's these allergies I have. Just affects my voice during the summer. Well, it's a year-round thing because it's the allergies in the summer, spring through fall, basically, and then it's just regular colds symptoms during the wintertime. It's just I feel like I'm always congested. All right, let's use the SPX. I don't have as many lines drawn in. Let's go to a longer term chart. Let's go to a weekly chart so we can kind of see it a little bit better. All right, so if you take the retracement from the all-time high all the way down to that October low, you can see that we are that line, this line right here, lines up with that, exactly with that 618 retracement level. Now, what does that mean? Well, the retracement zone, what the retracement zone says is that stocks will tend, the rule of thumb is that stocks will tend to retrace about 50% of their moves. So if you get a big move up like this, it'll tend to pull back about 50% of the move, usually in a corrective type fashion. And then usually they'll take off again. That's when the next impulsive move will start. Now, it's not exactly 50%, and you know, you shouldn't get too hung up on these ratios to where you're looking for exactness. Don't look for exactness in the market. You look for, you know, zones or areas. But the 618 retracement is kind of the deepest part of that. So the rule of thumb is that it'll retrace 50%, but it could be a little bit shallower than that, or 38.2%. These are all Fibonacci ratios, or a deeper retracement up to about 61.8%, or the 618 retracement level. Now, if it gets, so what it's basically saying is, this is, if it's going to have another move down, this is as deep as it should retrace that move, this initial move down. Now, there can be deeper retracements. You can have a 786 or 886 retracement. Those are really deep retracements, but they are extremely rare. And so what you have to recognize is, when you start to move above that 618 retracement level, the probabilities of getting that bigger drop start to diminish. And so it becomes more probable that you're not going to get that drop, which means it becomes more probable that you could rally back up to this high right here. Now, this is where we can drive ourselves crazy all day long. But I'm starting to do it because normally my analysis that I look at is not the same as the trading crowd. And so I usually feel pretty comfortable with my analysis, because, again, I don't like the whole trading crowd to think the same way I do, because the market will often punish the majority, right? So if everyone thinks the market's going to go up and everyone's confident the market's going to go up, it probably isn't going to go up. Okay, that's probably the point where it's going to go down. Normally when I'm doing this type of analysis, the trading crowd's already extremely bullish, and they're ignoring every bearish signal there is, and I usually feel pretty confident in saying, oh yeah, it's probably setting them up. They're going to be the fools on the wrong side of the trade, because we're going against the crowd here. But the problem recently has been that a lot of the trading crowd is seeing the same things I'm seeing, and so I get really worried that I don't. It reduces my confidence a little bit in my analysis, because I know the way the market works. I know that. And by the way, the frustrating part of this is it's not quantifiable. Okay, this is something that, I bring up the sports analogies all the time, but I'm telling you, there's something to this stuff. When everybody says that a team is going to win a game, that the other team has no shot, they shouldn't even show up. There's not a chance. I can't tell you how many times the underdog team has won the game when that's happened. And it's a phenomenon that you can't, like you said, you can't explain it. It doesn't make any sense, but you also can't quantify it. It's like, how do you calculate that? What's causing that? I don't know. There's some sort of a force out there that when people get too far to one side, when something seems absolute, the opposite thing tends to happen. And so what I worry about in this scenario here is that we break out above this level. I know that I need to say the probabilities start to diminish. It becomes less likely we're going to get that move down. The trading crowd is going to probably think the same thing. They're going to think that the bear market is over. And it is going to be the lower probability, rare, deeper retracement that it reverses on and slams everybody on. But I got to fight that. I tell you all the time, and I've got to stick to it myself. You got to try to stay on the right side of the probabilities. Try not to try not to uh, jump at too many lower probability moves or outcomes, or focus too much on the lower probability outcome, because everything's possible. And just to let you know, if we start to significantly move above this area here, I'm going to start adding positions to the portfolio. I'm aware. I'm going to look for warning signs, because a lot of times you'll get a warning sign of a reversal, and I'll try to. Hopefully, we get those, and we can manage things at that time. In case it does still happen later on, we don't get burned too bad by it. But I also don't want to be caught saying, now that the probabilities are diminishing, I don't want to be caught saying, I don't want to dig into my bias and say, well, it's still got to go down. It's still got to go down, and then fight that rally all the way, miss the whole rally all the way up because of my bias. Okay. So this is the area here that is, that I can calculate and say, okay, this is the critical area. It's not just the ratio. A lot of times, if it's just the 618 retracement area, I'll have a little bit more leeway with it. I'll look at the next possible support or resistance level near that area. In this case, it lines up almost perfectly to it. So I think that's a critical spot we got to keep an eye on. If we break above that, then we need to start adding some positions. Again, I still don't love the way it's moving. This is choppy. This is corrective looking. This is sluggish. But at some point, you gotta do something. And like I said, I don't want to be so dug into the bias that I ignore what the market is actually doing. If it's still grinding higher, well, then let's try to grind higher with it as best we can. Okay. All right. Question: could this be a larger degree wave B? Yeah, I've talked about that, and that is what I'm looking at. Is that that this whole first drop right here was wave A. This is wave B, and we're going to have wave C down. But again, if it starts to move above that area there, could it still be a wave B? Yes, it could, but it could get all the way up here and still be a wave B, and you could still get wave C. But by moving above the 618 retracement level, well, if it is going to be a real deep retracement, we could still trade this move and then just look for reversal warning signs. But I mean, it could just take off and really start looking impulsive, and that would really complicate things because, well, it wouldn't complicate things. It'd be, you'd go trade that. It's now acting like an uptrend at that point, but that's been the whole point all during this rally. Is it's not acting like an impulsive move. It's acting like a corrective move, which in the context would mean you got another move down. All right. Go to the Qs here. So the Qs, again, we have that. Usually you don't get this big of a drop off of the top, and that's the end of the move, meaning you're going to go right back up. So I think that's why we're seeing a little bit of a kind of a sluggish day. It's trying to rally a little bit today. Now it could be an inside day, which means you could have another move up tomorrow. But I think it could push higher. I'm not saying it still couldn't push higher itself, but that's well, there's a lot of warning signs here. You had the bearish reversal candle here, then it rallied up. You had an indecision candle on the Friday. That was on the big jobs report. The Nasdaq 100 didn't rally very much off of that. It showed an indecision day. You had the bearish shooting star candle on Monday, and then you had the drop here on Wednesday. So even if it does push higher, these are all warning signs that the buyers are weakening and the sellers are gaining strength. You're probably it would probably be a short-lived rally that would probably lead to a much bigger correction. Now, again, I'm not suggesting that we're gonna. I mean, things are in place for a big move down, but I'm still not calling for that yet. Usually, I get really confident in a big sell-off when everybody's just hyper bullish, and usually it's at the end of a decent-sized bull market. People are buying the dip and it's working every time, and then they buy the dip and it doesn't work, and then they panic. Usually that's when those bigger sell-offs are easier to read, but it could just be that we're due for a bigger correction there. Oh, let me go back to the SPY chart. So when I was pointing out the overbought on that 7-minute indicator on the direction alerts. So when we got overbought, we got these little pullbacks over the last month. Again, they weren't real big. They were 2 or 3 day pullbacks. And maybe that's all this is. Maybe this just comes back to this area and pulls back to this breakout area right here and then goes up again. Who knows? But it's just in that, that's why I'm saying it's hard to see it going. It could go higher, but it would be one of those where it would be, you start looking for bearish reversal candles in that process of it trying to move higher. All right, the Dow actually, one thing, that I'm trying not to ignore on the Dow chart is that it's still holding up as a potential inverse head and shoulders pattern, which is a very bullish type formation. You've got the left shoulder of the head, the right shoulder of the neckline, and if the market breaks, the other indexes break out, the Dow breaks out above the neckline there. Again, that's another one of those things where you'd have to force yourself to turn a lot more bullish. I'd definitely be looking at Dow stocks to maybe be getting into that look bullish as well, that could ride that wave if that were to take place. So now again, if all inverse head and shoulders patterns worked, I'd be a gazillionaire because I see them all the time. So I'm not suggesting that this is showing that it's definitely the market going higher, but it works a lot of times, which is why we like that pattern. I'd love to trade that pattern, and so this is definitely a bullish type price behavior. We have to pay attention to that. Now, what would change that? Well, the left and right shoulders typically line up in the same spot. Now, they don't have to be perfect. So if it did break back below here, it wouldn't necessarily, change the pattern completely. But the closer you get to the head, if this were to drop down probably into this area right here, you'd have to assume that that's no longer a inverse head and shoulders pattern. You get too close to the bottom of the head. And especially the fact that you already tested this right here, if you get back below that, that's not a good look for a head and shoulders pattern. And then how it dropped down there. If it really was an impulsive sell-off, panic, as some VIX started to spike and things like that, that might change that pattern as well. But I also don't want to ignore it, especially if the market breaks out above here. You start to, again, we don't look at one thing, but you start to add that up. Breaking above the 6-minute retracement of the move down on the S&P, Dow moving above the neckline of an inverse head and shoulders pattern. You can line up these things that say, hey, you got to be more bullish now. And this is the market telling you that you've got to change your bias. Now, I would say that you shouldn't have a bias at all, okay? But I've never met a trader that doesn't at least have a temporary bias, and my bias can change in an instant. I can be really bullish one day and really bearish the next day, but every trader has a bias. You can't operate without one. You've got to have confidence in your analysis, in your belief that the market should go up or should go down to make a trading decision, to risk capital. So instead of saying you can't have a bias or you shouldn't have a bias, I say I've adjusted over the years to say don't develop a strong bias, or don't let your bias ignore what the data is telling you, what the chart or the inputs are telling you. You can't dig in so much to where you start to ignore the signals that are coming. It's easy to do. You start saying, well, the VIX is important at one point, and then it's not important when it doesn't confirm what your bias is. And you can easily start to do that with all this stuff if you're not careful. That's why I like to use a lot of different things though too. So it's not just one thing that I'm relying on to tell me what to do. It's a number of inputs, and I can start to see where that shift starts to take place, and it's a lot easier to change your bias when it's not, it's at least a longer term bias. It's easier to do it when you're not trying to flip a switch on it, but you're seeing the gradual change, and you're saying, oh yeah, this is gradually shifting to more bullish or more bearish. All right. Sorry, I didn't need to spend so much time on the indexes, but all right. So here's the NASDAQ 100, or excuse me, the Russell 2000. So we can see the two big days. Now, got a bearish inside day today. We'll see if that leads to it pulling back a little bit. But this is kind of that catch-up move. Money coming out of the big cap tech, going into the small caps. That's just a rotation taking place. That's actually kind of a bullish type of behavior. Now, if we back out a little bit, we're going to look at, we're bumping up against a key level. Major support back here. Bumped a little bit, came a little bit above it here and a little bit above it here. Right at the line through these little this resistance period here, and then we're right back up to this area. So not a surprise, we're seeing a little bit of a bearish inside day. We'll see if that leads to it pulling back a little bit, coming back down. The bottom line is you really have a sideways range that you can really focus on too. I mean, we can see how it reacts to this line in the near term. That's kind of the midpoint of this range. So if it breaks above here, it's probably going to work its way up to here. If it holds right here and drops, it's probably going to work its way back down to here. The key is going to be when it breaks below here or above here, and that's a pretty long way away. But that's something to keep an eye on this chart too. Is see what it does here in the near term. But if it does break above here, this is the next focus up here, the sideways range. Does it break out of that long sideways range? Because it did this before a few years ago. Easier for me to go to my other charting service here. Hold on. It was stuck in a sideways range for over a year, or about a year. It did have a little false breakout right here, and then it came right back down. But right when it broke that range, that's when it really started to drop. Okay. Now we've got another range established here. We break above that, that'd be pretty bullish. Although you'd want to make sure it's a solid breakout. This was a weekly chart, so this was it stayed above here for about 2.5 weeks, and then came right back below it. But those are the key areas you'd want to look at on the small caps there on the Russell. Bond market is still just chaotic and moving sideways within that range. Again, back out, we can see that sideways range. It keeps holding this support level. It's had a pretty sharp rally right up into here, but it kind of rallied into remember this range we were looking at a few months ago. It kind of rallied up to the underside of that, and now it's coming back down. It's like it's going to retest this area again down here. But again, until we break below here, that'd be bearish for bonds. Break above here, that'd be bullish for bonds. There's not. We're kind of stuck in that range until we. Now we break out above or below those areas. That's going to be significant, and then you'll see the market will likely react to whenever it breaks out of these ranges. The market will recognize that, usually react to it. Gold has a little bit of a pop today with the dollar. A dollar had a big drop, but the dollar might just be in a wave C of a ABC pattern. We'll look at that here in a second. I still think gold might pull back a little bit further here, and I do have the gold trade. I might end up getting stopped out of that, but I'll show you when we look at the dollar. What bothers me about the oil chart is that because the dollar dropped so much, you'd expect oil to at least get a rally or a bounce off of that alone, but it's down today, and it's been in the sideways kind of mess as well. I haven't trusted any. I've looked at some oil stocks, but I haven't trusted any trades in those just because of the erratic behavior lately of the price of oil. But here's the dollar move. In fact, it looks a little bit cleaner on my. If I look at the dollar, this is the dollar ETF. That's what we use here on TradersPro to look at the dollar movement. Remember, this was not a real move right here. And that'll fall off when the data provider corrects that. Here's a look at the dollar index right here. And this is what I was talking about, that it's down big today, but it could just be wave C of an ABC pattern. It had this big run up right here. And so if that is just the end of a correction and it does start rallying, the dollar starts rallying a little bit, that would tend to be more bearish for the markets. At least it just depends. Sometimes the markets don't react to, and it really hasn't been reacting strongly to the dollar. But there's a tendency for the market to be a little bit more bullish when the dollar is falling. Not always, but definitely for commodities, and that would be more bearish for gold and oil if this is just a wave C and then it starts to rally off of that. But we'll keep an eye on that. Sometimes reversals look like ABC patterns. This could also be wave 1, wave 2, and you're going into wave 3, 4, 5. If for a second it looked like a bullish ABC pattern, but it was actually part of a downtrend. But it is getting to an area here, especially if it gets down to where this trend line is, where if that's a wave C would be about the same length as wave A. You look for that relationship in the ABC patterns. All right. Oh, and then the VIX. Down below 14 now. And again, I think I pointed this out on Tuesday. It's not that it can't get down below there, but when it was down below there, it got down to 12. That was right before the COVID thing hit. It was right at the market time, a long bull market that we were in. It was right in this. I have to back up a little bit because it was right in. It was right in here. And this was coming all the way up from the financial collapse low, years and years and years. We had been moving up for years. And that's when you would see the VIX down that low, the complacency, because you're complacent because the market has gone up for so long. You don't fear any sort of downward move, right? We're definitely not in that. Everything's pointing to the danger of a downward move, and whether you're looking at the chart or whether you're looking at fundamentals or world events or what have you. Recession signals are starting to flash all over the place, and the market's whistling past the graveyard. Man, I just it's just amazing. I just and again, for some of you, this is meaning nothing because you're brand new and you've never looked at a VIX. You don't even know what a VIX indicator is, and uh, but the bottom line, if you don't understand, that when professional traders, when they think a sell-off is coming, if they sell those, they've got millions of shares that they own. If they try to sell all those shares at the same time, they'll crash the market because they're such big positions. It floods the market with supply. Who's going to buy those? There's only small traders available to buy them. If all the big institutional traders are selling at the same time, no one's there to buy, and it crashes the price. Well, that could wipe out years of gains that they've made in one week. And so in order to be able to sell as fast as they need to sell, what they do is they go buy protective puts. They buy put options that'll go up in value when those stocks go down in value. And it's an insurance policy, and it doesn't perfectly protect them, but it saves them a lot huge losses. Okay. Well, the problem is that those protected puts cost money. You got to pay for them. You got to pay for that insurance. And so what's happening is that they've been paying for the insurance because we're in this bear market and in these conditions that we're in, but they haven't needed to use it. We haven't dropped. In fact, we've just moved stagnant or sideways. And so month after month, they're paying this money on these protected puts, and they haven't needed them. And now they're not getting enough money on the moves of the stocks. The stocks aren't making big moves to offset what they're spending on those protected puts. So what's the pressure on them to do? The pressure on them is to say, I haven't needed them. We're just kind of sideways. We're not getting any gains. I can't afford to buy them because we're not getting any gains on our positions to justify that cost, or I don't want to buy them. I don't want to spend that money and diminish the little profits I'm already getting. Well, what that is doing is it's exposing them now. Yes, they haven't needed it yet, but as soon as something breaks, as soon as something comes out that freaks the market out, everybody's going to be selling, and everyone's going to be going and buying those protected puts as fast as they can because they're exposed. And that's what I mean by a ticking time bomb. It's you don't need it until you need it, right? And when you need it, it's going to happen so fast that it's going to catch you off guard. Now, what these people, this is human nature. I can see it so perfectly in my mind that they are just hoping each day that goes by that they haven't bought the protection, that they're okay. They're hoping that they just won't need it. They're hoping that the market will break through this level and keep going up, and they're just not going to need it, again, they're just hoping that it will work out, and that then they'll buy it later, right? When it starts to take off again, then I'll buy that protection. It may be that, and that's what I'm saying. The VIX is not saying a crash has to happen, but it's got the conditions now. The fire is built, and the kerosene is on the fire. It's just waiting for the match. And I don't know what that match is going to be. I keep looking at the jobs report and the Fed meeting. And a lot of times it's something that's unexpected. We saw that a couple months ago with the regional banks that came out of nowhere. Yeah, I mean, that's hopefully that explanation helps a little bit when you see me just amazed that the VIX keeps dropping as it is. It's and typically we've seen when it even got down to these levels, we saw the market sell off for those few days. It's gone down even below that. We're even at the very least, we're probably due to see a little bit of a move down. Again, 20 is that's complacency. We're below complacency. This is just regular fear up here at 30. That's not even panic yet. But man, so if you hear people amazed, you hear people on TV talking about the VIX being this low and being amazed by it, that hopefully that explanation helps a little bit, help you understand that. All right, man, I really ran long on the update part. I didn't mean to do that. But I also, as you can imagine, don't really want you loading up on a lot of new trades in this environment. But let's take a look at a few. Under the new buys, we'll start there. I was looking at this GNW, Glenworth Financial, 92 strength rank. And mostly just, I mean, you can just look at this as being a little bit of a sideways range here. I like this impulsive move up, corrective, and then it's breaking out of that. So it should expect it to maybe run up to that, at least up to that previous high right there. So maybe this isn't a real long-term trade, but there really have been a lot of long-term trades out there lately. Might have to just take advantage of some shorter-term expected moves. Another one under the muscle stocks, this ACAD, Acadia Pharmaceutical, 91 strength rank. Mostly just being in an uptrend, coming off of a pullback right here. Now, again, the danger sometimes we don't see a real clear ABC look to it, is that maybe that's just wave A and this is wave B and you get wave C. But this is a pretty deep move up now to where I think that was the correction, and it's acting like it wants to go higher. You can put a stop down below here, and you can manage it that way. Another one, last one. Actually, no, let's go into the aerospace and under the buy section, because this barely turned to a buy signal, but I like this XL Corp, HXL. That's an 84 strength rank, so it's dipping down a little bit, but I like the pattern. Kind of a cup with handle formation right here, cup with handle, and it's close to breaking out. So you could wait for the breakout as confirmation there in case it doesn't break out and comes down again. But that's a pretty bullish looking pattern there, so I like that one, even at an 84 strength rank. Under business services, I liked this CPRT, 91 strength rank. And it just looks like it's in a little bit of a consolidation ABC pattern. Now, sometimes with these sideways looking patterns, they can be sideways for a while. So a lot of times I like to wait for the breakout above the range there so that I'm not caught in the, you get in and you're like, oh, that looks like a corrective pattern. We should go higher. And you probably will, but you spend the next month still moving sideways, and then that's no fun when you're not going anywhere. So that could be a little bit of confirmation you look for there. And then in the energy space, oil and energy, although these aren't oil stocks, they're more of the alternative energy. But First Solar, 98 strength rank. Now, this one didn't need confirmation because this is what this is based off of, is this looking like an ABC pattern right here. But you'd want to see it start to move up or have a bullish candle. It might still dip down a little bit further and fill in that gap right there. But definitely would look for some confirmation. But this stock has been on a tear. I think it's the S&P 500 company that's had the biggest gain. I think it's up like 200% or something like that. It's up like 200%. Now, again, do you want to buy it when it's already come up this fast, this far, this fast? Well, again, it could just be a trade where if things start to move back up again and the market starts to move back up again, maybe it just comes back up here and retests that resistance area or something like that. But I just thought I'd throw that one out there as one that looks like it could be in a correction. Now it could be also, and like I said, it could be that it topped out right here. This is just wave 1, wave 2, and you're in wave 3, 4, 5, and you got a lot further to drop. But then again, that's why I'd wait for a little bit of confirmation, wait for it to look like it's starting to move back up again. Wouldn't hurt. And then one more in energy, oil and energy. This ARRY 95 strength rank. Again, it still could be in a wave C, but it looks like this is maybe wave A, wave B, and maybe it's in wave C, which comes down a little bit further, but this looks corrective right here. I like how it was dropping down. It had lower highs, lower lows through here, and a higher high, higher low, higher high. And then I don't know if this will put in a higher low, but it looks like it's kind of turning back to being bullish again. This overall kind of has that bull look to it. Could you wait for it to break out as a confirmation as well? Yeah, you could do something like that if you wanted to go on our watch list and wait to see if it breaks out. Now, one last one here. Consumer staples. Those Twinkie lovers out there, Hostess Brands, TWNK is the ticker symbol. 83 strength rank, so it's down a little bit there, but it had a nice little pullback right in here. Impulsive move up, kind of corrective right into here. Looks like it's starting to move back up again. I think the longer term chart looked pretty good too. Yeah, so you got this big drop right here, and then since then it's been kind of working its way up the right side of the bowl, so to speak. And it, you can manage it pretty easily there. Get a stop just down below here. Wouldn't be risking very much. All right, real quick check. Portfolio. Let's take a look at it here. So gold, I'm still in. My stop is down here a little bit further, so it's still possible I could get stopped out of that. This one was based off of this potential ABC pattern right here. I think I have my stop. It's a pretty tight stop. I think it's just right below here, but they haven't gone anywhere since I got in that thing. It's been sideways. So I don't see a reason to get out yet, but that's not encouraging that it's not moving up. KDNY, this is based off of this inverse head and shoulders, potential inverse head and shoulders pattern. I think I got in on this breakout right here. I think my stop, if I'm not mistaken, it's right below here, this right shoulder. So it could be that this is just pulling back to the neckline. We'll see how it looks there. Now this is one that well, let me double check where my stop is on that one, where I put it. $20.50. Yeah, so it's down here below that right shoulder. But if the market starts looking more bearish and we break down below that neckline, I might go ahead and just stop out of that. I don't see a reason to write it all the way down to here if I think the market conditions are looking a lot more bearish. And if this move down is looking more impulsive down as opposed to corrective. SGML still looks okay. About ready to maybe break out. And then this was my hedge. I had a hedge with the SLXS, the semiconductor, but that was based off of SMH, that was based off of the chip stocks looking like they were having a wave C down, and they still could. But I was looking at wave A, wave B, and they were looking like they should have a wave C down right here. And since then, it's kind of fought that a little bit. What I'm worried about is that maybe this is wave A, this is A, B, C of wave B, and then you get your wave C. I think chip stocks, though, should pull back a little bit further. A lot of them look like, you look at AMD, looks like a wave A, wave B, and we should have a wave C. Could probably come back down and fill in that gap there. NVIDIA. NVIDIA, again, this could be one that maybe that was wave A and this is working on wave B and then has wave C. That was not as clear, but look at something like Micron that actually looks like it might have already completed a wave C. Wave A, wave B, wave C. Pull back to this breakout area here. But because I could see if the market does rally a little bit stronger from here, that a lot of money would just jump right back into chip stocks. So I'd like as my hedge, I felt more comfortable with the SARK from here. That was looking, the ARKK was looking more bearish. So I've got that as my hedge. Had a little bit of a bullish reversal candle yesterday. Down the market's rallied a little bit, so it's down a little bit today. But let's pull up the ARKK, because this is moving opposite of the ARKK, which is the ARK Innovation Fund. And so you can see a little bit clearer on here. She had this big bearish reversal candle. It's fighting a little bit here, but where we're getting that bearish reversal candle. Again, it may just be a little pullback into here or something. But that's what these hedges. If I think the market can pull back a little bit, all I'm doing is looking to, if I've got long positions, looking to protect those long positions, or if I don't have long positions, I might use these inverse ETFs, just try to make a little bit of money if the market drops without being short the market, without having to short the stock. So that's how I use some of these inverse ETFs. And really all they've done lately is just keep us at break even. I've been at this $137,000 level for, it seems like forever. Up a little bit and down a little bit, but right around there for a long time. That'll change, but I'm okay with that until we start seeing stronger bull market signs out there, or we get our panic sell-off out of the way. All right, real quick check on the SPY again real quick before I wrap things up. I just want to see, it was fading a little bit, but now it's back near the highs of the day there. So like I said, that's not shocking, but it might push a little bit higher. But keep an eye on that area, particularly tomorrow and Monday before our next class, to see if we do reach that critical area, and then do we see any sort of bearish reversal candle at that point. That'll be what I'm watching for. All right, thanks everyone. Have a great weekend. We'll see you Tuesday for the market update class. Bye now.